Hi everybody, my name is Paul Gerard. I'm a student loan consultant and I'm very pleased to be working with the Young Physicians Institute of the American Podiatric Medical Association to provide you with some repayment modules designed to help you do a better job of managing your student loans. This fourth repayment module is on federal consolidation and refinancing your student loans, both federal and private, with private lenders. Now we start by talking about federal consolidation, and note that we are not using the term refinancing here. As you'll see here in just a moment, when you consolidate into the government's federal direct consolidation loan program, you actually get a slightly higher interest rate. More on that in just a moment. Federal consolidation is paying off multiple federal loans with one new federal loan. If you decide to do this, then the federal government's direct consolidation loan program is the only option for consolidating federal loans into a federal consolidation loan program. The government took over all the lending of federal loans in the 2010-11 academic year. So once again, this is your only option to do a consolidation loan in terms of federal consolidation. The application is available online at studentloans.gov. And although you're not choosing who you are consolidating with, once again, you're doing this with the federal government, you can now choose among 4 different loan servicers contracted by the federal government to not only process your federal consolidation loan, but service it as well. And these are Great Lakes, Fedloan Servicing, Nelnet, and Navient. In terms of pros and cons to federal consolidation, well, certainly an advantage would be the convenience of one loan servicer. We referenced in an earlier module that many recent podiatry graduates already have all their federal loans with one servicer. But if you have multiple loan servicers, federal consolidation would certainly get you the convenience of one loan servicer. If you only have one loan, you can only have one loan servicer. Borrowers who are interested in the public service loan forgiveness program that we talked about in the third module, if you have any non-direct loans, then consolidation into the federal direct consolidation loan program can help you maximize how much will be forgiven under public service loan forgiveness by converting non-direct loans into direct loans. So once again, that's a distinct advantage for folks who are interested in the public service loan forgiveness program. Loans that are not consolidated, the maximum repayment term is 25 years. Depending on the balance that you have, if you consolidate into the federal direct consolidation loan program, you may be able to extend repayment up to 30 years. In terms of disadvantages, those of you who are going to be interested at some point in aggressive repayment, you can always pay a federal consolidation loan early with no penalty, but you only have one loan at one rate, so you can't target the extra money on the worst loan. If you don't consolidate, then you likely have different loans, different federal loans at different interest rates. And once you choose a repayment plan, if you decide to overpay, you can work with your loan servicer and target the additional funds on the most expensive loan, like a Grad Plus loan. You simply can't do that or get the biggest bang for your buck with a federal consolidation loan because, once again, you only have one loan at one rate. Now, we did mention that you get a slightly higher rate under the federal direct consolidation loan program. I don't know of borrowers who don't consolidate for this reason, but we want to put this out there. The way that the rate is calculated, it's a weighted or blended rate of all the interest rates of all the loans you're consolidating, rounded up 1/8 of a point. That's only 0.125%, and then it's fixed for the life of the loan. So a slightly higher rate, but not a prohibitively higher rate. If you consolidate too early, you can lose grace periods, and if you include a Perkins loan in the consolidation loan, the Perkins is converted to an unsubsidized balance, and Perkins loans are subsidized loans. So advantages and disadvantages to federal consolidation. So very simply, how do you know if you're a candidate for federal consolidation? We hope this will help. You may be a candidate if you have multiple loan servicers. Once again, recent graduates probably have all their loans with one loan servicer. But you may be a candidate if you still have multiple loan servicers and you want the convenience of one. You may also be a candidate for federal consolidation if, once again, you're interested in the Public Service Loan Forgiveness Program and you have some debt that is eligible for consolidation, but it's not in the direct loan program. You want to move your entire balance into the direct loan program to maximize your potential public service loan forgiveness amount. But you may not be a candidate for federal consolidation if you're interested in aggressive repayment, which we just talked about, and you want additional payments to go on your worst loan. You may also not be a candidate if all your loans are already with one loan servicer. Most of the loan servicers offer something called combined or single billing. You may have multiple loans with them, but regardless of which repayment plan you choose, you can actually have one payment and they know how to allocate it among the different loans they service. You may also not be a candidate for public service loan forgiveness if you're just not interested in the public service loan forgiveness program, or perhaps you are, but all your loans are already in the direct loan program. So we hope this will help you determine whether or not federal consolidation should be part of your repayment strategy. Now let's talk about private refinancing. This is where private or commercial lenders, including some credit unions, are offering to consolidate or refinance student loans, including federal student loans, by promising lower rates and substantial savings in repayment. Now note that some of the lenders, some of the programs are targeting only certain disciplines such as medicine, dentistry, and law, and in some cases, the lenders are targeting graduates of certain schools. You'll have to find out by contacting the lenders and looking at their requirements whether or not they are willing to make a loan to you based on your discipline and based on the school that you graduated from. Also, some of the lenders will want to see a history of steady income, not just potential income. Once again, that may vary by lender. So private refinancing, private lenders offering to consolidate or refinance your student loans with the promise of lower rates and substantial savings in repayment. If you are considering refinancing your student loans, private, federal, or a combination of those, there are a series of questions we would encourage you to ask of any private lender before you take the plunge and consolidate or refinance with them. Certainly ask about the interest rates and the capitalization frequency. For example, with regard to interest rates, do you want a variable rate or a fixed rate? And if it's a variable rate, you need to find out, is there a limit to how high the loan can go in terms of an interest rate? And is there a minimum rate that can be charged? Also, you most certainly want to know on a variable rate how often the rate can change and how much of a heads up you get when that happens, because that can impact future payments. Clearly, you want to know about repayment plans. Often with private lenders, the repayment plans may be 10, 15, 20 years, depending on how much you borrowed. It's unlikely there is a plan that's tied to income, but that's certainly something to ask about. You also want to ask about postponement options, and are there any fees if in fact you need to postpone your payments at some point. That would be especially important if you were in residency thinking about this. You also want to know if there's an impact when you postpone, if you're allowed to do it, on capitalization, meaning how often accrued and unpaid interest that goes on during that postponement period is added back to the principal balance. Now, the postponement options may not be a concern to a practicing podiatrist, but they certainly would be or should be to someone who's in residency, or they're more likely to be of interest to someone in a residency program. We highlight these two, repayment plans and postponement options, because federal loans tend to have far greater repayment plans and postponement options available on federal loans as opposed to private. Certainly also find out about cosigner requirements and cosigner release. This is where after a designated number of payments, you can apply to have a cosigner, if you have one, dropped off the account. And at that point, they're no longer liable for repayment of the student loan. You may want to also ask, are there other services that are being offered by the lender that you may not need that you are inadvertently or indirectly paying for? Such as, I believe one of the private lenders is offering an unemployment counseling of some kind to perhaps help you find a job if you lose yours. This may not be something that you need, and if you don't need it, you certainly don't want to pay for it. So a series of questions to ask as you're considering, number one, do you want to refinance your student loans? And number two, if so, who you want to do this with. So are you a candidate for refinancing or not? Let's take a look. You may be a candidate if you're ready to start actively paying on your student loans, perhaps aggressively so, and you would like to trade higher cost debt for lower cost debt. That would make sense. You might be a candidate if that is a characteristic you have, ready to start payment right now. You may also be a candidate if you're just not interested in an income-related repayment plan or forgiveness program that tend to be associated with federal loans and some of the repayment options there. You may also be a candidate if you're really not concerned about postponing payments. You're just, again, ready to start paying on your loans as quickly as you can, and you just like to get a lower rate. But you may not be a candidate if you need to be cautious with your payments, if you perhaps want to start paying, but you need an income-related plan, and perhaps if you're interested in forgiveness, including public service loan forgiveness, you would not be a candidate for private refinancing. You may also not be a candidate if, once again, you are interested in possibly having to postpone your payments. Notice that these four tend to define or are characteristics of residents, and that's why we would caution you about refinancing in residency again, unless you're ready as a resident to actively start paying on your loans, perhaps aggressively, perhaps you have another resource to help you do so. We hope these questions will help you determine whether or not you're a strong candidate for refinancing your student loans. In terms of resources to help, on our homepage, pgpresents.com, we have some tips on consolidation, specifically on federal consolidation, and there's also information on federal consolidation on studentloans.gov, including the online application. We hope this short module will help you determine if federal consolidation should be part of your repayment strategy, or if you should consider refinancing your student loans with a private lender. We wish you best wishes for every success in your podiatry careers.